Because people invest in order to grow their money, it's important to be able to properly measure your performance relative to the level of risk you are taking. For example, if you had a portfolio of individual Canadian stocks and the return for the year was 12% for all of your holdings, is that good? Well, it depends. If the return for the S&P/TSX Composite Index, the main benchmark for the Canadian stock market, was up 25% for the same year, then your stock picks underperformed the market by 13%. Conversely, if you had an actively managed U.S. equity exchange-traded fund that had a return of negative 5% for the year, is that bad? Again, it depends. If the overall U.S. stock market was down 15% that same year, you would have outperformed the market by 10%. These two examples show the importance of benchmarking your portfolio. For every asset class you are exposed to, if you are using active management, you'll want to see whether those active management decisions are working out for you. Another example will demonstrate how taking into account your level of risk is also important. Let's say your portfolio is made up of 30% Canadian stocks, 40% US stocks, and 30% Canadian fixed income. The return for your portfolio over the year was 7%. Is this good? We won't really know unless we calculate the weighted average benchmark return. Luckily, it's easy to do this. We simply take the return for each asset class and multiply it by the weight of our exposure to these asset classes, then sum up all the numbers. Let's say the benchmark for Canadian stocks, the S&P/TSX Composite Index, was up 6% for the year. The benchmark for US stocks, the S&P 500, was up 15% for the year. And a benchmark for Canadian fixed income, the FTSE Canada Universe Bond Index, was up 2% for the year. We then multiply each of these returns by the weight of our exposure to each of these asset classes in our portfolio. We held 30% in Canadian stocks, 40% in US stocks, and 30% in Canadian fixed income. Multiplying these out, we get 6% times 30%, which equals 1.8%, 15% times 40%, which equals 6%, and 2% times 30%, which equals 0.6%. We add these all up and we get 8.4%. This is higher than our portfolio return of 7%. We underperformed by 1.4% for the year. There are a couple of things to keep in mind. 1 year of underperformance or outperformance may not be enough time to draw any conclusions. You'll want to review your performance every year and also look at longer-term periods of comparison as well. Underperformance or outperformance of your overall portfolio or for the individual asset classes may suggest you need to look at your portfolio more closely to see why there was such a difference in performance. Are you not diversified enough? Are you only exposed to higher volatility investments from within these asset classes? If you are a passive investor using broad index tracking funds, you don't have to worry much about your performance relative to the benchmark because you are tracking a benchmark by design. You can expect returns very similar to the benchmark, minus a small drag of the management expense ratio of your index funds, plus or minus what's called tracking error. Finally, if you are only exposed to Canadian or US stocks, comparing your portfolio's performance to a globally diversified benchmark can help show you the benefits of global diversification over the long run. While Canadian or US markets can be 1 year's best performer, they can also be another year's worst performer. Would you be better off with less concentration in your portfolio? With the lessons in this course, you have the foundations for setting up your portfolio for success in the long run. You can revisit these lessons anytime for a refresher or to get ideas for areas you want to learn more about on your own. While we've covered a lot, it's important to know that every investor will continue to learn more about investing and about themselves over time as they go through various market events and cycles. And remember, if you need help, help is available anytime you have questions.